let's bank on the banks, as you want to put it. Obianuju Nsofor from Afrinvest. Good morning. It's good to have you here.
Thank you for having me.
When banks are reporting, the market seems to be a little bit warm. Sometimes could be really hot because the banks are at the back of everything and every stock we have on the market. So what does the current trend of earnings tell you?
Well, you're right. Over the last 2 weeks, we've seen a number of banks release Q3 2017 earnings scorecard. But what we've seen is sort of a mixed performance. Typically, we see a trend, especially in the Tier 1 space. Take, for example, last year when there was a lot of challenges in the banking industry, as well as FX liquidity. The devaluation that occurred in June 2016 sort of gave a boost to non-interest income. So we saw banks around this period record significant gains in terms of non-interest income. Also, we saw CAR come under pressure, not for the Tier 1 banks, but for the Tier 2 banks. This is that risk-dominated FX loans were sort of revalued upwards and sort of gave pressure to the CAR. But however, the Tier 1 banks, they showed resilience. Overall PBT and return on equity for the industry came out positive, but not for the Tier 2 banks. Then you fast forward to 2017, as at half year, we saw these banks sort of move towards trading in fixed income securities in order to give a boost to non-interest income. Given the heightened risk landscape, we see that banks are not willing to lend to the risk, to the real sector. They will sort of alternatively shift towards investment in government securities in order to give a boost to interest income. So we saw a lot of activities go down in the non-interest line item. However, you trickle down to Q3 2017, and we've seen sort of a mixed performance in the all Tier 1 banks have released their results, and there's no usual trend as we saw in half year 2017 and also for full year 2016. But however, for the Tier 2 banks, due to that, the fact that not all of them have actually, we've seen the likes of Sterling, Stanbic, Fidelity, and Wema Bank release their results. However, the main problem with Tier 2 banks is that some of them have their CAR near the regulatory threshold. So we are looking at the likes of UBN, we are looking at the likes of Unity and Sterling. I mean, Union Bank came out, I think last year, about this year, to say that they want to raise capital via rights. Yeah, via rights issue. I think it also ends today, but we believe that this will be successful, given that they have strategic investors who are more likely to take up their rights. I mean, the rights issue is to shore up their CAR levels and also target lending towards growth sectors of the
capital adequacy issue is still there. Is it a severe problem?
Well, definitely. You see that last year, that was some of the issues that Skybank had, that CBN had to do a takeover. So it's still...
And Skybank hasn't even reported yet.
Yes.
We don't have 2016?
Yes.
And we don't have any quarterly report so far in 2017?
Yes.
So technically, Skybank is about almost 2 years now in deficit.
Yes.
Reporting.
So we are yet to gauge the exact performance of Skybank as of now. So yes, CAR is definitely something to look out for.
Who should we be worried about when it comes to capital adequacy ratio? Tier 1 or Tier 2 banks?
Well, for the Tier 1 banks, they are quite safe. All 6 of the banks are well above their threshold. For the Tier 2 banks, we have the likes of Union Bank, we have the likes of Sterling, and we have the likes of Unity Bank. So, and Diamond Bank as well. They are yet, aside from Union Bank, we are yet to hear any major capital raising from any of these banks.
Should investors be worried?
Well, yes, they should be. As you would also notice that there's been a whole lot of interest towards Tier 1 banks, and investors have sort of stayed away from the Tier 2 lenders. So they've sort of captured this in their investment strategy and stayed away from these banks.
In terms of the earnings we have, the satisfactory ones, the good ones, and the not so good.
Well, for the Tier 1 banks, it was sort of below expectations, despite the fact that we saw 9 months 2017 results come out impressive for the likes of Zenith, Access, UBA. Guarantee was sort of below expectation. There is premium that investors give to Guarantee, but although that we saw declines in major line items, in terms of ratios, return on equity, in terms of cost efficiency, the bank has done very well. Also, ETI's 9-month result was largely positive, but this is from a low base of 2016. If you remember, they recorded a loss as of 2016. But what was surprising, because on a quarter-on-quarter basis, when you analyze the performance, these banks, they didn't do too well, except for the likes of First Bank, who reported decent 9-month results as well as quarter-on-quarter earnings. If you look at their results, gross earnings was up. Most of these banks, Tier 1 lenders, due to the FX gains recorded in Q3 2017, they suffered from a high base effect this year. So you see that non-interest income was sort of pressured. But for First Bank, we noticed that non-interest income fell about 40%. But then again, there was a boost in interest income. And due to the fact that they restructured about 8% of their loans this year, we saw a drop in impairment charges, which sort of trickled down to the bottom line and gave a boost to it. On a quarter-on-quarter basis, they recorded improvements on all major line items. I mean, First Bank, the share price has sort of rallied this year, and we attribute it to investors' confidence in management in order to reduce their cost pressures. In terms of Tier 1 banks and the whole industry, gross earnings for First Bank surpasses all other banks, but the bank has sort of suffered from operating expenses and high impairment charges due to the fact that they are largely exposed to high-risk sectors, such as the power sector and the oil and gas sector.
If you're a big bank, then you got to take some heat.
Yeah.
And you're the oldest anyway.
Yeah.
By the way, when you look at Q4 trading, the 9 months, half year would be the only result you have before the year rounds up. Nobody's giving you anything, except the latecomers like Skybank. So right now we're getting to the middle of Q4, and it's Q3 numbers that we're using as a mirror or as a guide to for the rest of the year as far as the back sector. So what do you think the trading on this latest earnings should be like for the final weeks of 2017, since we have no major earnings that will come in until we step into January?
Well, definitely, if you look at the results for 9 months 2017, when you compare on a year-on-year basis, there are major improvements in line. Even for the Tier 2 lenders, there are major improvements. Our outlook for Q4 2017 is largely positive, given that there's an improvement in the macroeconomic landscape, especially for FX liquidity. So we had the likes of manufacturing and the general commerce sector. So we expect impairment charges, the line items should actually show improvement based on this. We expect banks to also maintain their dividend policy. If you look at on the average, it's about 33% thereabouts, and this is exactly what investors will be looking for in order to take position into the market. So for Q4 2017, we expect improvements for the period.
But whatever investors are doing between now and the end of the year, would they be doing? Would they be focusing on 9 months, or do you think they'll be looking at what does the 9 months will tell us about full year?
Well, definitely, they'll be looking at 9 months results. Despite the fact that we saw declines on a quarter-on-quarter basis, these banks have sort of relied on gains from Q1 and Q2 2017. I mentioned earlier that there was a switch to trading of fixed income securities in order to give a boost to non-interest income. As of now, banks are sort of lending towards the real sector, but not as much as as
everyone will want.
So definitely we expect this to affect line items and sort of give a boost to bottom line.
Let's see how things pace out. We'll have you here before the year comes to an end. We're just ending October, so we still have November and December. Quite a long way to go when you're trading the market. A day can make a lot of difference.
Yes, it can.
Whether you're making money or you're losing money. Have a great week ahead. Thank you very much. Obianuju Nsofor, who is one of the research analyst team at Afrinvest, of course, just launched the banking sector report for 2017. You want to lay your hands on that very heavy volume and research document or book, to put it more precisely, you know where to get it at Afrinvest.